You may know Kevin Warsh, Trump's nominee for the next chair of the Federal Reserve. And you definitely know Scott Bessent, the current U.S. Treasury Secretary. One could shape the path of U.S. interest rates over the next few years, and the other is directly involved in the making of American fiscal, debt, and capital market policy. But what if I told you that behind both of them stands the same mentor? And that man, someone most ordinary viewers have probably never really heard much about, is Stanley Druckenmiller. Druckenmiller is not a typical Wall Street celebrity. He rarely makes headlines, rarely gives interviews, and has never run for public office. But on Wall Street, he is almost a legendary figure. He once achieved a record that still sounds almost unbelievable today. Around 30 years of roughly 30% annual returns, without a single losing year. And that is not even the most legendary part. What truly made him part of financial history was the 1992 trade that changed the course of finance. Quantum funds short against the British pound. A lot of people have always assumed that was George Soros' signature trade. But many people familiar with what really happened know that the core judgment, the framework behind the trade, and the real leadership came from Druckenmiller. That single trade earned Quantum Fund more than $1 billion in profit. In the London office at that time, one of the young analysts helping carry out the key research and verification work was none other than today's U.S. Treasury Secretary, Scott Bessent. Later, Druckenmiller shifted to managing his family office, and one of the people who worked closely with him for years, learning markets and macro thinking by his side, was Kevin Warsh, who would later become a candidate for Fed chair. And once you see that, you realize something striking. Behind the two most important centers of economic power in America today, the Treasury and the Federal Reserve, you can see Druckenmiller's shadow. In January 2026, he recorded the Hard Lessons series and had a conversation with Ariana, Morgan Stanley's global head of derivatives distribution and structured solutions. For anyone who follows macro, policy, and markets, content like this is incredibly rare because it may be one of the few chances we get to closely observe how this legendary investor actually thinks. After watching this interview, there were 3 parts that inspire me the most. In the rest of this video, I'm going to walk through those 3 ideas. And beyond that, toward the end, I'll also briefly talk about his views on several hot topics right now, including AI, gold, digital assets, and more. Those topics are not the main thread of the interview, but they're still very interesting, so make sure you stay until the end. The first point is his investment methodology. Druckenmiller has a very core idea. Do not invest in the world as it is today. Invest in the world 18 months from now. In his view, the real opportunity is not in what has already happened, but in what is about to change and in how the market will eventually reinterpret those changes. In other words, he is never betting on a static reality. He is betting on the change in perception itself. Teva Pharmaceuticals is a very typical example. At the time, the company was almost unattractive in the eyes of the market. As a generic drug company, it was trading at only about 6 times earnings. It was not popular, not exciting, and very easy to ignore. But what Druckenmiller saw was not how dull the company looked at that moment. What he saw was that an important transformation was happening inside the business. The new management team was trying to gradually move Teva away from being a struggling generic drug company and toward becoming a growth company built around biosimilars and innovative drugs. The problem is that companies in transition are often in the most awkward position. Growth investors think the transformation is not complete yet, while value investors do not like the growth direction. So the market keeps valuing the company under the old narrative. And that mismatch is exactly where Druckenmiller saw the opportunity. He bought at $16, and within a few months the stock rose to $32. The essence of that move was not that the company suddenly became something completely different in the short term. It was that the market finally began catching up with the change he had already seen earlier. And that shows you something important. His most typical way of trading is not chasing outcomes that have already been validated. It is identifying the early signs of change and then positioning for the market's future repricing process. The second point, and in my view the most thought-provoking one, is that very famous Soros-Druckenmiller idea. Invest first, investigate later. It almost sounds like it goes against common sense because most people think you should thoroughly research a company first and then decide whether to buy it. But Druckenmiller often does the opposite. When he feels a strong intuition, He will often establish an initial position first, and then conduct deeper research while already holding the trade. If the later analysis confirms that his original judgment was right, he will scale up quickly. If he finds that the thesis does not hold, he will exit decisively. His reasoning is simple. The market will not wait for you. Too much analysis can become counterproductive. By the time you finish analyzing everything, the stock may already have moved much higher. And at that point, you fall into a very typical form of investment paralysis. You know the company is good, you know the logic makes sense, but you still cannot bring yourself to buy because the price has already run up. And in the end, you just watch the whole move without participating in it. That was exactly how he approached NVIDIA. At the end of 2022, when he first bought NVIDIA, he had not done the kind of traditional deep research that many investors would expect. He acted more because several important signals were all pointing in the same direction. One was that a partner he trusted was very bullish on AI. Another was that engineering students at Stanford were shifting their focus from crypto to AI. And from a macro perspective, the broader logic chain also made sense. Then ChatGPT was released, the AI narrative heated up rapidly, and he kept adding to the position again and again. What is most worth noticing here is not just that he caught NVIDIA, is the logic behind his whole decision-making process. He did not wait for everything to become certain before acting. He made sure he was in the right position as soon as the most important signals appeared. The third point is his understanding of position sizing. Druckenmiller himself put it very directly. He said that the most important thing he learned from Soros was position management. In his view, the most important part of investing is not whether you are right or wrong, but how much you make when you are right and how much you lose when you are wrong. He even said that position sizing may account for 70% to 80% of the entire investment decision. That statement is extremely important because it almost redefines what investing really is. A lot of people think the core of investing is prediction, who is smarter, who can analyze better. But Druckenmiller cares much more about whether you can size up aggressively when the big opportunity is there and control the damage when you are wrong. If you get the direction right, but the position is too small, you still will not make much money. On the other hand, even if you are occasionally wrong, as long as the position size is appropriate and your stop-loss discipline is strong, you can still survive. So what really separates investors is not just judgment, but position sizing. Beyond those 3 points, his views on several current hot topics are also worth paying attention to. Take AI, for example. His attitude is a very typical example of open-minded thinking. He does not agree with very absolute statements, such as AI will definitely cause mass unemployment, or AI will definitely be massively deflationary. Because history has repeatedly shown that every time a new technology appears, people say jobs will disappear and the world is ending, but reality usually does not unfold in such a simple first-order way. He used radiologists as an example. AI is already very strong in certain kinds of imaging recognition and pathology judgment, but the real-world result is not that radiologists disappear. Instead, they spend more of their time communicating with patients, explaining diagnoses, and helping with decision-making. In other words, in his view, AI is more likely to reshape the content of work than simply erase entire professions. Asset bubbles. He has always been very sensitive to this issue. His view is that the truly dangerous big problems are often not ordinary recessions, but rather situations where a large asset bubble appears before the recession. In other words, what tends to create systemic risk is not simply that the economy slows down, but that asset prices are first pushed into distorted territory. At the same time, he did not say that we are already at the most dangerous point right now. His message was closer to this. Risk has entered the later innings, and it is something worth watching carefully, but it has not yet reached the final breaking point. Then there is the US dollar. At the time, Druckenmiller was bearish on the dollar, but his logic was not based on some emotional American decline narrative. It was much more practical. He looked at the issue through purchasing power, historical ranges, and the positioning structure of foreign investors. In his view, the dollar was already at a relatively elevated level, and foreign investors were already heavily allocated to dollar-denominated assets. In that situation, if foreign capital does not continue to aggressively add to U.S. assets, then the dollar naturally faces downward pressure. Then copper. Druckenmiller admitted very directly that this had already become a fairly obvious consensus trade. Over the next few years, copper supply is likely to stay tight, while AI and data centers continue to drive demand. But in terms of implementation, they prefer to own copper itself rather than make oversized bets on copper mining stocks. Then gold. Druckenmiller's understanding of gold goes beyond seeing it as a simple monetary trade. For him, gold also carries geopolitical and defensive significance. In other words, gold is not just a way to trade changes in the monetary environment. It is also a way to absorb global uncertainty and systemic risk. So when he looks at gold, he is not only thinking about rates and inflation. He is also placing it within a much larger international context. Then the bond short. Druckenmiller does not treat it as an isolated one-way bet. He sees it as part of the broader portfolio, more like a hedging tool. If the economy is stronger than expected and inflation proves more persistent, then that position can make money. And if his main thesis turns out to be wrong, that trade can at least help buffer the volatility of other risk assets at the portfolio level. And finally, crypto assets. Druckenmiller's attitude here is clearly split. He remains fairly skeptical toward many of the traditional narratives around crypto assets. Put differently, many traditional cryptocurrencies still struggle to answer the most fundamental question: what real-world use do they actually have? So in his view, that category of asset does not automatically possess strong investment value. But on the other hand, he is clearly positive on blockchain, stablecoins, and tokenization. The reason is simple. These are areas with clear use cases, especially in payments and financial infrastructure, where they have a real chance of being adopted at scale. In particular, stablecoins. He even said that over the next 10 to 15 years, payment systems may increasingly be replaced by stablecoins, because compared with the traditional system, they're faster, cheaper, and more efficient. Someone like Druckenmiller rarely shares his thinking in a systematic public way, so every time he's willing to talk openly about his views, experience, and investment framework, it is genuinely very rare. And for us, the real value of this kind of content is not simply finding out what he is bullish or bearish on right now. It is using the opportunity to update our own thinking. Because the market is always changing, and if our understanding is still stuck in old frameworks, then many of the most important changes will remain invisible to us. That is why I personally feel this kind of content is worth revisiting again and again, and worth taking the time to slowly digest. If you also enjoy this kind of deep dive into how top investors think, remember to like and subscribe. I'll see you in the next video.